Hi, everyone. You have two of your favorite members of the Connecticut Wealth Management Investment Committee here with you today. I'm Jarrett Solomon. I'm the acting chairperson of the committee. I'm here with John Shanley, who manages the day-to-day operations. And while we don't have a tactical shift in target portfolios to share with you, we are at the midpoint of the year and wanted to spend just a few minutes talking about some of our thoughts, pointing out some themes we're seeing in the market, and also talk a little bit about a question or two that we have been discussing a lot. Well, it's been an interesting 6 months, to say the least. The first quarter lost 20%. The market was down 20%. That is the worst quarter in the history of the market. And in the second quarter, the S&P 500 gained 20%, which is the best quarter in over 20 years. So the market is still down year to date due to the mathematics of loss, but most would agree that this has been quite the stunning recovery, all within the backdrop of dismal economic data, unemployment numbers that are shattering records, and I'll call it a delicate political landscape, to say the least. So the most common question we've been getting from clients is why? How is this possible? How can a market recover in the manner that it has amidst all this bad economic data and an uncertain economic future, to say the least? So John, you want to spend a minute or two just talking about that and also some of the risks that we're seeing out there?
Absolutely. I think that's a question we're getting a lot because common sense would dictate that the stock market and the economy should be related, right? You would think that they would go hand in hand, but the truth of the matter is it's actually much more complicated than that. And that's what this year is highlighting. And if we take it down to kind of first principles and we look at economic data, that data tends to be either real time, meaning it's looking at what's happening today, but more often than not, it's looking at past data. So for instance, jobless claims, like you just mentioned, GDP report, right? When we look at a GDP report, it's telling us what the economy did, whether it grew or contracted in the previous quarter. Right. And all of that stuff matters for the stock market. But what the stock market is really concerned about is what's going to happen into the future. So the millions of participants that make up the market are making guesses and assumptions about what might be happening to corporate profits. And then those expectations come back into today's price. And I think related to that factor is that the market doesn't look at data from an absolute perspective. It's not asking, is this data point good or is this data point bad? It's really more relative. It's saying, is this data point getting better than expected or is this data point worse than expected? Right. And just as you mentioned, Jared, it's been an incredible year. And it's going to take us a long time, most likely, for the economy to get back to where we were in January. But even these last couple of months, we do see data coming out that's better than we expected in terms of the economy trying to get back to where it was. I should mention, with all of that said, there are still a whole host of risks out there that we need to be even more cognizant of, right? We're continuing to figure out how to reopen this economy. We have Q2 earnings season next week, and businesses will give us an idea of how they did last quarter, and more importantly, what they're going to do or what they expect for the future. And then finally, as you mentioned, we have this little political thing coming up in November, right? And that has its own sources of risk that we have to be mindful of. And I think this all goes back to one of our main tenets in investing is to stay diversified. The future is inherently uncertain, and so we have to continue to be diversified and manage portfolios with that in mind.
Yeah, I mean, I think that's such an important point. I mean, if ever there's been a 6 months to remind us how important it is to align an investment strategy with your financial plan, it's been the first half of this year. It's just so critical to align your investment portfolio with plan needs so that when we have periods like the one we've just gone through, you're not taking more or less risk than what's required in order for you to have enough to do the things that you want to do. You're not left guessing or wondering what might be appropriate. And it was on the last call or the last investment committee blog that we had where we talked about bonds. Bonds have done exactly what they're supposed to do in a volatile stock market, right? They've played a very important role in client portfolios this year. Not to mention that they can be used for cash flow so that you're not forced to sell stocks at disadvantageous times. So again, it's just so important. These last 6 months have accentuated how important it is to align your investment plan with your financial plan. I think that's it. John, any parting words of wisdom for the group here?
I don't know if it's wisdom or not, but obviously reiterate what you just said. That's so incredibly important. I would just add one last thing. We talk about risks from, the sense of those risks can turn into bad outcomes, but risks can also present quite a bit of opportunity, right? So just know that we're looking at this stuff continuously, and we'll make changes and moves when we deem appropriate. And Jarrett and I will be back to talk more.
Yes, I know you can't wait. So with that, we appreciate your time. As always, please feel free to reach out to us with any questions. Thank you, and we hope you stay well and stay safe.